4, 3, 2, 1.
Good afternoon. I'm Jim Eskin. On behalf of Eskin Fundraising Training, it's my privilege to welcome you to our nonprofit empowerment webinar series. This is number 53. That's a lucky number in the Eskin world. And I think it's very timely. It's talking about cashing in on the donor advised fund bounty. And I'm going to introduce my guest here in a second. First of all, it's a joy to have two friends from MassMutual. And I want to say that thanks to Fred Steubing, I have had a wonderful 2-year relationship with MassMutual. And Todd, actually, Fred partnered with something that I was really eager to do. I call it the happy learning hour, that you have a little networking, you have the instructional component, and then you have some more networking. And then Fred has so many skills, he makes me jealous. And one is being an expert at craft beer. And we really put happy into the happy hour. So Fred has done a webinar with me before. Fred and Todd are going to go back and forth with their questions. But I want to wish everyone a happy Cinco de Mayo, which celebrates or commemorates Mexico's victory over France on May 5th, 1862. In 10 days, we're coming to another very significant, the 170th anniversary of MassMutual, which was founded in my neck of the woods, Springfield, Massachusetts, on May 15, 1851. Fred, I'll start. Can you tell us, you all are a mutual company. Could you just, what is a mutual company?
It's essentially a company that's owned by its policyholders. We don't have shareholders that we answer to our policyholders. That's really the cut and dry of it.
You know, it reminds me, I work for a cooperative, and I've introduced Fred from Tucson, Arizona. I played a little with your title, Todd. I hope I don't get into trouble with the MassMutual police, but I shorten it to Director of Estate Planning. Tell us about how long have you been with the MassMutual family?
So I've been with MassMutual about 7.5 years. Before that, I worked at another large insurance company in the Chicago area, but for another, 12, 13 years or something like that. Can't remember the exact date.
I had to ask. I've been there. I know it's great for golf. How'd you pick Scottsdale?
Because it's great for golf. It was an opportunity to change jobs. Wasn't, at the previous company had some issues, whatever. So it's just a good opportunity that popped up at the right time. It happened to be in Scottsdale, and just as time for a change, we just leaped at it, and we're happy that we did it.
I first met Fred. We're both members of the same college fraternity, Delta Tau Delta. We went to different colleges, and we got together, I don't know, it was 2.5 to 3 years ago at a Starbucks. I'm so glad we did. And Fred, did you tell me at that time, Jim, I got 3 words for you: Amazon, Zoom, Peloton. Okay, so we're going to make you and Todd are responsible for knowing, the future, right? Everyone else is. So
No.
I pitch myself every morning on how well the stock market is doing. I literally do. And then I pinch Andrea. What are you projecting? I mean, didn't we hit another record today? What are you all projecting for 21, 22 as far as the market?
We want to try and be careful on that. Our jobs as an advisor or my job as an advisor is not really to predict the market, but have a plan for what the market does, whether it's up or down. Most analysts think that the rest of 2021 should be pretty strong, and then they're kind of reserved in their predictions beyond that. But the economy seems to be heating back up, and that's kind of what we're anticipating.
Okay, and I'm going to let Todd, and they're going to be like a wrestling tag team, and they're going to tag in and tag out. So I'm going to continue. I'm going to start what I particularly wanted to get what I call my big punch questions right up front. A lot of people think that gifts and estates are only made by wealthy people. Todd, can you comment on the reality there?
Well, the fact of the matter is, the wealthy people do, set up when they give to charities, they set up sort of complicated strategies or use complicated techniques to give to strategies like private foundations or charitable remainder trusts, which are complicated strategies. But for everyone else who's not that wealthy, because those cost a lot of money to set up, it's there are strategies to help make gifts to charities. You don't have to be wealthy to do that. It's sometimes as easy as just it's easy as just writing a check or even donating your time. But there are ways for those that are not the ultra wealthy, the wealthy, however you want to define them. There are ways for those other people to make considerable dent in making charitable contributions and to be able to make some smaller contributions and still have an effect.
Hey, this question's in the same spirit. And I think there are a lot of smaller nonprofits that think, it's just the large supranational organizations can talk to their donors about donor advised funds and about gifts made from estates. And that's not true. Can you all respond to that?
Well, donor advised funds are one of those strategies that really make it easy to make gifts to a number of different charities, which I'm sure we'll talk about in a little bit. But as far as the nonprofits, it's really, I guess, about persistency, and soliciting and asking the question. Always ask the question. I'm sure everyone here has probably been approached at one time or another, and they're just being persistent.
Hey, let me ask too. These are tough questions. You're going to dig into a lot more details, but what's a simple description of a donor advised fund? In part two, why are they exploding so much? Why have they become so popular?
I think I already answered the second part, but I will go back. But for the first part, a donor advised fund is, think of it as a fund, almost like a managed fund where somebody can contribute money to and get that charitable deduction when they make the contribution to the fund, but they don't have to decide where that fund gives the money to, or what charity that fund gives the money to. It's just a vehicle for somebody to make smaller gifts and then decide later on who should receive those gifts.
Hey, Fred and Todd, this is the point. I promised you 32 seconds to deliver your disclosure notice. So go ahead, please.
That basically says, don't believe anything I tell you.
You sound like a politician.
So I am an attorney. I'm a tax attorney, estate planning attorney. I am not an attorney for MassMutual. I don't represent MassMutual in anything. And so even though I know what I'm talking about and have experience in what I'm talking about, see your own tax advisor. Don't believe anything I tell you.
Hey, Susan Albert, are you there? Let's move to your question. And by the way, can Susan talk to us?
Can.
Okay, Susan, tell us it again. I think you said, I wanted to clarify, how can we get in front of people? Do you mean in front of donors, or do you mean in front of financial advisors and institutions? Or do you mean both?
I think both. I'll recount a conversation I had with someone at the area foundation. They reached out to us and they said, we can't do a lot of funding this year, but what can we do to help you? And one of the questions I asked them is, you've got a lot of donor advised funds there. How do we get in front of these people? How can information get to them about what our organization is doing? Because they may not know anything about us. So
okay.
that's part of it.
Okay, so I'll tell you what, we've established 3 learning objectives, as you see on the screen, and let's move immediately to the 4th one from my colleague, Susan Albert. And remember, most of our audience is smaller nonprofits, and that, by the way, I'll show you a slide, 88% of the 1.5 million nonprofits in the country have assets, a revenue of under $500,000. They're small. how can the smaller nonprofits get in front of these financial institutions that administer the DAFs?
So in that regard, I'm going to use a phrase called like minds and like interests. So being around those donors that have certain interests, you want to participate in those same kinds of activities, if you will. If they like to boat, be around boating. If they like to golf, like Todd does, be around golfing. They want, there's an old term you hear a lot called KLT, know, like, and trust. They want to deal with people that they know, they like, and they trust. And that also means similar activities and similar arrangements, if you will. So that's a really cut and dry way to get in front of those folks. And sometimes it's just as simple as picking up the phone and saying, hey, we're looking for an opportunity to service this particular organization or this particular cause. Does that align with what you do and what you want to contribute to?
Did you say know, like, and trust?
I think I mentioned know, like, and trust. Jim.
Right. Okay, we share that. Okay. We're going to get close to the Q&A portion. And by the way, I'd like to introduce Michael Largent, who is our producer from Gay Day Media. Michael, what does the audience do? They can ask questions two-way. They can type it in the chat space, or I would rather they come on camera like Susan. Let me introduce Michael.
Yeah, so basically there's two different ways to ask questions. If you want, you can just type them into the chat space and then I'll read them to Jim and the panelists. But what we really prefer is for you to turn on your webcam or just your microphone and then actually ask them yourself. So those are your two options.
Thank you. And by the way, we have a little tradition at this stage of the show, and then we're going to go into our Q&A with our subject matter experts. I'd like to ask everybody to type in the 3 words non-profit strong, okay? And then I'm going to give my first tough quiz to Todd and Fred. What are we, by the way?
Non-profit strong.
You got it. You got it. Susan, what are we?
Nonprofit strong.
You get an A. Okay, well, hey, Todd, are you ready to go to our Q&A? And again, anytime someone in the audience, you can either type it in the chat space, we're audience first, or you can come on camera. Okay, Todd, I've got some easy questions and not so easy questions. So you're a golfer, you have easy holes and not so easy holes. And my first question is, do most charities accept DAF gifts?
I have never heard of a charity not accepting a DAF gift. I mean, it's a charitable contribution. Why wouldn't they want to accept a gift from a DAF?
And by the way, to give people a little perspective on scale, it's okay to say the F word, Fidelity Charity. They granted $9.1 billion in DAF grants last year, recommended by their donors. They became actually the largest grantor. They took over from United Way. I mean, that's just Fidelity Charitable. Todd and Fred, come in anytime you want. Generally speaking, for what kind of donors are DAFs a good fit?
Well, I think, one of the benefits of a DAF is that they're simple. And I always whenever I talk to agents or clients, I always try to keep it as simple as possible. I mentioned before, there's a lot of other, complicated strategies that people can come up with. But if they just want to make a gift, maybe they don't know who they want to give it to yet, which charity they want to make that gift to, they can make the gift to the DAF, right? As simple as writing a check to the DAF and then waiting. They get the deduction when they write the check or when they contribute it, and they don't have to they can decide later as far as when or what nonprofit that the DAF should distribute to. So it's easy. It's those that also that just don't know who they want to give who they want to make the gift to as well. But they need the charitable deduction for tax purposes, or they just like to give the charity. They just haven't figured out which charity what to give to.
Hey, you jumped ahead to my next question, but I love it. talk about the tax advantages of DAFs. And by the way, I got your slides loaded here, so you just tell me. I'm going to
Yes.
just advance them kind of
Yeah, okay, let's see where we are.
randomly.
That's fine.
But go ahead. What are the tax advantages? I think you alluded to that before, but I think that's something worth repeating.
Yeah, well, it's a charitable deduction. You get your income tax charitable deduction when you make a gift to the charity or to the DAF. Not, not when it goes to the charity, but actually when you make the gift to the DAF. And depending on the type of assets you give, will depend on what your actual, how much you can actually deduct. But if we're talking about, smaller gifts, generally it's all going to be deductible. But cash is going to be, you can if you give cash up to 60% of your adjusted gross income can be deducted. If it's a capital gain asset like mutual funds or stock, it's going to be about 30. It's going to be 30%. But you get the deduction for the full fair market value of that stock. So it really sort of depends on the type of asset. But the main, one of the biggest advantages is that you get that deduction when you write that check to the DAF or you contribute that property to the DAF.
And then it can reside in that account and it can grow, and it doesn't have to be granted to a charity until the person who deposited money wants to, right? They pull
right.
the trigger.
Exactly. And there may be some rules within individual DAFs that might, change that a little bit, but generally you're correct. They don't have to make the gift until whenever they decide. And again, that's one of the advantages that, that DAFs have over just making a direct gift to a charity.
We're going to take advantage, DAS, but you know about estate planning and the biggies on gifts. I was wondering maybe you could take a moment to talk about, by the way, the audience is made up of nonprofit CEOs, executive directors, directors of development, board chairs, board members, and some volunteers. Talk a little about how these nonprofits can think about marketing estate strategies to their donors. Let's first talk about charitable bequests.
Sure. So you can leave, in your will, you can leave a specific amount of money or your entire estate to a charity if you want. These days with the estate tax exemption so high, it probably won't get a deduction for it, but generally it's 100% deduction for whatever you leave at death to a charity, no matter what type of to a public charity, no matter what type of asset it is. For those that might not have kids or any, or family they want to leave it to, or they want to just give leave a legacy and give a portion of their estate, they can do that right from their will or right from the revocable trust.
Okay, hey, let's talk about retirement plans. How can a nonprofit talk to a good donor about considering including that nonprofit in the retirement plan? So
the retirement plans actually goes back to what you first brought up about the rising stock market, I think, is that a lot of people have IRAs, and I lump IRAs, 401ks, all sort of the same thing, but that are large, that are quite large. They've increased in value over the last year and so last several years, last decade or so.
Huge capital gains exposure, right?
Yeah. Well, IRAs are a little bit different. It's all ordinary income, so it's not necessarily capital gains.
Thank you.
But you can make a charity a beneficiary of your IRA, and a portion of your beneficiary. It could be the primary, or it could be the contingent, which the contingent would take over if the primary dies. So that's one thing and that allows the individual to still maintain control. If they get upset with that charity, they can always change the beneficiary at any time. Or another option would be to take money out of the IRA while they're alive. Once they're over 59 and a half, they don't have to pay a 10% penalty, and then make a gift of the net income from that to the charity. So they take the money out of the IRA, pay the income tax, whatever's left over can be gifted to a charity. Although recently there's a new tax law that came into play probably about 3 years ago, something called a qualified charitable distribution, which if you're 70 and a half or older, you can direct your IRA custodian to make a distribution directly to a charity up to $100,000 per, and if both husband and wife have IRAs per spouse, that what the advantage of that does is that it satisfies your required minimum distribution. It also, it's not a charitable deduction, but you don't have to take the money into your income first and then pay the tax and make the gift. So it goes directly from the IRA to the charity. So it's that advantage of being sort of straightforward, not having to take the money into your own pocket first and pay the tax.
Hey, you're on a roll. How about gifting with life insurance? How should nonprofits speak to their good donors about life insurance policies?
Well, there's a few ways with life insurance. One, I think that's a popular way for nonprofits. I think that everyone here would probably agree to, is that name the nonprofit as a beneficiary on your life insurance. If the individual doesn't need the life insurance for its intended purpose that it was purchased for, years ago, they can always name the charity as a beneficiary, so they know that upon death, the charity is going to get that death benefit. Another strategy that is becoming more and more popular is for those donors that give regularly to a specific charity. And this can be different between insurance companies, but a charity might want to insure that. So if someone is giving $10,000 a year to a charity, and if that person dies, well, that $10,000 is going to stop. But the charity might be able to buy life insurance on that donor. And so that, the individual still makes the donation to the charity. The charity uses that donation to pay the premium on a policy. The charity owns the policy. The charity will get, can control it, can use the cash value. They don't have to wait until the individual passes away to use any of the cash value. And when that individual dies, they get a death benefit. It's sort of like, if you know what key man insurance is, where a business wants to insure a key employee because they know if that employee dies, the business is going to be hurt. It's sort of the same concept. The charities realize that if this donor dies, well, that $10,000 a year is going to stop, and they want some insurance to help overcome that.
Let's talk about another thing. The stock market, did it hit new record highs today? A lot of people are holding on to highly appreciated stock. Talk about using your stock to make gifts to your favorite charities.
And that works for using stock, using appreciated assets like stock, where there's capital, where there's built-in capital gain. The one option is to sell the stock first, but then you got to pay the tax on the capital gain, and then whatever's left over you can give to the charity. But you can give the stock directly to the charity, not have any capital gains tax by selling it, but the charity can then sell it and they don't pay tax. And so the entire amount is available for charitable uses as opposed to just the net amount after paying tax.
Todd, I appreciate you're really going at a good clip. And this is good. So I'm going to bring Fred in a little. Fred, for our nonprofits that are lucky enough, and I got to tell you, I was a fundraiser for 30 years. And when the word endowment came up, a big smile came on my face. For those nonprofits that are lucky enough to have endowments, what is your advice on the investing and the distribution sides?
On the investing side, it's plan for longevity. I mean, you obviously want to have growth, but you want to plan for longevity. As far as the distribution side, it's budgeting to make sure you never spend more than what you can account for in any given year, and not to spend down your endowment so quickly that it runs out of money. I think anybody who sets those up would agree that it's something that you're looking for longevity and perpetuity. You're not looking for something that's going to be there and gone within 5 to 10 years. So having a good accountant to plan with, having good attorneys like Todd to plan that with, but also having good advisors to help structure what's going in and what's coming out makes a lot of sense.
Let's talk about making a lot of sense. I guess April 15th is going to be, I think in Texas, we now have June 15th since we froze away a week or two. But can you talk about Congress has actually made it kinder to make charitable gifts? They had some goodies in 2020 and they have extended it into 2021. Can you talk about some of these tax advantages for making a gift now?
Sure. So obviously we know last year, and with COVID, and there's a lot of legislation to help individuals, help businesses, and so forth financially that came out of Washington. And there were, and there were specific provisions within the CARES Act, which was the act from March of, I think it was passed in March of 2020, which changed a little bit of the charitable, made it a little easier for individuals to make charitable contributions, because it first of all, it put in a $300 charitable contribution for non-itemizers, for cash contributions. So generally, in order to take a charitable deduction for charitable contributions, your total deductions have to be greater than the standard deduction, which for this year I think is $25,000 or something like that. So it's a lot. So it's pretty high. And so generally, a lot of people can't itemize because they don't have that many deductions. Their property taxes, their mortgage interest, their state income taxes aren't that high. And this was with the 2017 tax law that actually doubled the standard deduction. So for allowing this $300, anybody can take $300 off their gross income and now be able to, and get the benefit of that. Additionally, another thing that was put into play for the CARES Act was for cash contributions, you can give up to 100% of your adjusted gross income. The prior law was 60%.
That's a biggie. Could you repeat that, please?
So you can give up to you can get a deduction or a cash contribution of up to 100% of your adjusted gross income. So if your adjusted gross income was $100,000, you can give $100,000 to charity, not have to pay any income tax.
That's
the prior rule. That's not bad. The prior rule was 60% for cash. Now this is it's limited in the sense that it's cash contributions. It's also limited in the sense that it's for only public charities. It doesn't actually include donor advised funds, as does the $300 for non-itemizers. That doesn't include DAFs. And those both were continued in 2021. There's a Consolidated Appropriations Act was passed this year, which made those permanent. And also for that $300 was actually made up to $600 for a married couple who files jointly, so they doubled it. The two changes with respect to tax law and charitable contributions.
Yeah, great answer. By the way, I have like 500 more questions online, but I always want to make sure the audience has a chance. Michael, is there any questions either in the chat space, or better yet, we'd like people to come on camera?
This was from a bit earlier. I think you've kind of touched on it, but it was from Kristen. She asked, is there a good reference that shows all the percentages and benefits for donors handy somewhere?
You could probably find that online somewhere. That'd be, a lot of times, people joke about Google, but sometimes Google's a pretty good research tool. And you should be able to find for, different types of assets that go to different types of nonprofits. For instance, a charitable public charity versus a private foundation versus a DAF versus a supporting organization. A lot of those have different deductions depending on the type of asset that you're going to give. And you should be able to find some sort of chart out there.
My late mother would inspire me to ask this question, and I don't know if Todd or Fred wants to take it. Are there any negatives that you all can think of making gifts through DAFs?
Well, the only thing for the regular donor, not the wealthy or the ultra wealthy, I don't think there is. Like I said, it's simple. You give the money, you decide who gets it later on. The money grows tax deferred, tax free, in sort of in mutual funds that the DAF picks, and it's simple. But the one downside, I guess, to that is that you don't really have control. You lose some control. Whereas maybe a private foundation might be appropriate for those who are more wealthy that want to sort of retain control of everything and decide how they want to give, how they want to invest. And there are some certain rules associated with that might make it a little bit more, it gives that control to the donor who sets that up. But that's probably about it. I mean, I guess also there's charitable techniques where you can, make a gift and get the charitable deduction, but still get some income back for your lifetime. You can't do that with a DAF, but you can do that with some other strategies. So, it really depends on the goals of the individual.
Yeah. Okay, let's get, I want you guys to tag team on this one. You know, I was in the nonprofit sector for 30 years. I've been advising. It's the old saying, if a tree falls in the forest and nobody hears it fall, did it really fall? And, you know, how can small nonprofits market, yes, we are working with our donors and friends on DAFs. How can they make that part of their integrated marketing and conversations with donors and friends?
That's a tough. That's sort of not my area. I don't know, Fred, if you have any insight on that.
The key thing is just making it known that DAFs are a tool that they utilize in accepting donations. You don't have to have big private foundations. In fact, to quote some statistics, the number of DAFs in existence in the last 20 years has quadrupled. But interestingly enough, the amount in the DAFs has been reduced by 2/3. So people have found value in using DAFs, but the amounts in the DAFs are not quite as big. Millennials, those that are about 21 to 35, have found a very charitable nature in their giving, especially over the last year. And so just being public and asking, hey, you know, are you looking for an opportunity to give? And being a charity or a nonprofit that actually is working on a cause that speaks to people. And that sometimes is harder than asking for the money.
Hey, and I'm going to share an Eskin pearl, and that is most nonprofits have a donation website. Tonight, do you have donor advised fund? Is there a button for that? And if they're not, tomorrow, make sure you add a button for donor advised funds. Let me get back. By the way, Michael, any other questions from the audience? By the way, Todd, we're doing great on time. We're doing great on time.
Yeah, I see Diana asked a question.
Does she want to come on screen?
I see your camera, Diana. If you want to unmute, you can, or I can just read it off.
Okay. And I came in late, so I apologize tremendously.
Oh, wait a minute. This is Diana Hoyt from Phoenix.
Right.
Well, you can go coughing with Todd Janower is in Scottsdale.
Oh, okay. Hi, Todd.
Hi.
But like I said, I came in late, so if you've already answered this, just tell me, you know, I was a bad girl. But I know the rules have changed regarding a donor requesting funds to pay for things at a special event and pledges.
Good question.
Could you discuss those?
No, I'm not an attorney, Todd.
I am a pledges. I don't know any rules about pledges. You're talking about as far as when they can take a deduction or for a pledge?
My understanding was that if you make a pledge, you used to not be able to have your pledge paid through a donor advised fund because you're paying for a pledge you made that
makes sense.
The payments, you know, but my understanding is that Congress in its wisdom, we'll talk about that later, said that if you tell the nonprofit, I am making this pledge and it will be paid by my donor advised fund. If you put that up out front, then you can make the pledge payments through your donor advised fund. So you're actually pledging money that doesn't even belong to you.
Right. I don't have any. I'd have to get back to that because I don't really know what any changes have been made in that respect.
And I'll tell you what, in your defense, Diana, when you say we as a fundraising industry, that's what's called campaign accounting. I mean, those are being updated. You know, can you say Arizona State has a $1 billion campaign. That's probably pretty ambitious for them. You know, they can count pledges as long as they're in writing. And all those type of details are, Diana, they're changing all the time, right? Per the ACE and AFB. By the way, Diana is a very accomplished trainer. She wrote a wonderful book called Formula for Fundraising. and she was crazy enough to be my subject matter expert on writing a case for support. Was that 3 weeks ago?
I think so.
Okay.
So,
I'm
so
sorry.
Jim, no, there's a couple of questions that popped up as I'm reading through the chat as well that I'd like to address. And I know Todd will jump in and add to or correct if I'm misstating. Keith, is it Stava or Stava? I apologize, Keith. Go ahead.
That's right, Stava. You talked very briefly about endowments. Is 4% still the standard spin-off to operations a year, or with the stock market going so high, has that 4% crept up?
Actually, the 4%, if you talk to most advisors, has crept down. And the reason why is it's typically based off interest rates and things that you can earn guarantees on. And because guarantees are lower now, you're looking at accounting for lower distribution percentages in order to continue to maintain your endowment. And so 4% is a good general number, but talk to your accountant, talk to your advisors, and make sure that the number really fits where your endowment is earning and what expenditures you have in that endowment. When I talk to my clients, I typically advise 3 to 3.5% because I want to work, again, longevity and perpetuity. I'm going to tend to work from a more conservative position.
I got to just mention, I ran for 10 years and was a dream job, a community college foundation. And we built the endowment from 3 to 24 million under my watch. So I took some pride in there. But I think setting the spending policy, I needed my board the most on that issue. We started with an investments committee, but you got hawks and doves. Some people don't want to go higher than 2.5%. Some people want to go 4.5 and 5. That's when you needed wisdom of the whole.
And then Jim, Marv has a really great question. And how are you, Marv?
Wait a minute, is that Marv?
Yes, sir.
Is that Marv or Roy? Why don't you come on camera?
I'm on camera.
There you go.
There he is. By the way, I want to tell you, you guys have met. Marv has come all the way from upstate New York to enjoy your craft beer, so it was pretty good. Okay, Marv, how you doing? Hey, you're not shoveling snow today, are you?
No, it's a rainy day though.
Okay.
Rain.
Marv, your question was, do you see expanded government regulations on horizon regarding mandatory payouts from DAFs, much like those governing family foundations? I know Todd and I spoke about this a little in preparing for this. So Todd, I'm going to say a little bit and then
Sure.
I'd appreciate you filling in. The answer is yes, there's discussion. Especially with regard to the perpetuity in which funds can live in DAFs. I mean, you can literally deposit the money and it can live there for years and years and years. So there's been some discussion about enacting legislation that forces DAFs to pay more like endowments, which Todd, correct me if I'm wrong, I believe is 5% mandatory. Mandatory assets.
For foundations, private foundations.
Yeah, for the foundation, for the foundations, it's 5%. And so there's discussion about making that also applicable to DAFs as well.
Yeah, there's some concern that people are using it. They're using the DAFs as parking lots, and they're just banking a lot of money, and it's just kind of seeing banks to be better used in the nonprofit sector to do good work. So they want to try to inspire that, I guess.
Hey, by the way, let me interrupt for a second because Keith, I want to get back to you for one moment. We all know Marv also has been a guest presenter. He's been to Happy Learning Hours. And he is the CEO of a wonderful, wonderful organization called the Institute for Philanthropic Excellence. But Keith, we didn't ask what nonprofit you're representing. I wanted to welcome you to our learning community.
I'm with Mercy Medical Angels.
And what do they do?
We're the nation's largest provider of charitable transportation for low-income people to get to their medical treatments across the country.
Thank you.
24,500 free trips last year.
And by the way, out of curiosity, did you have a spike in activity due to COVID?
Yes and no. Because of COVID, a spike in requests because there's a lot more people that are low income now because of the economic impact. But we're fighting against so many of the medical centers were closed down to everything except COVID and emergency treatments, that, and the commercial airlines were nearly grounded. Our volunteer pilots were nearly grounded, but we also have gas cards, prepaid gas cards, ground transportation. So that's kind of taken up the slack. So it's a yes and no, Jim.
Well, thank you for the service and leadership you provide. Todd,
Jim, I looked at Diana's question. Look at that question. I just want to, if I could talk about that.
I'm sorry. Go ahead.
Yeah, because Diana asked about the pledges and using DAFs to fulfill pledges, and there was something passed that probably hidden in the 2017 Tax Act that allowed grant recommendations or allowed donors to utilize their DAF to satisfy pledges. Provided there's some requirements there, but yes, that is now a change to make it a little easier, to use DAF monies to satisfy pledges.
Thank you for clarifying that. There's talk now that our baby boomer generation is going to, I can't even get my mind around this number, is going to transfer $68 trillion over the next 20 to 30 years. By the way, someone told me if you took $100 bills, you could wrap itself around the planet twice. That's how much $68 trillion is. Suggestions from you all, how you're working with a combination of baby boomers and maybe their millennial children, but how can nonprofits position, because that money can go to loved ones, it can go to philanthropy, or it can go to government, right? That's about 3 places for that money to go. How can nonprofits position themselves for this, mind-boggling $68 trillion wealth transfer?
The first, I'm going to jump in on that one. The first thing is just have the discussion, and you have to determine, are we individual givers? Are we givers as a couple? Are we givers as a family? And then make that decision. Once you've made that decision, if it's a familial giving, then you have to teach your children and your grandchildren the value of the giving that you're doing, and let them know up front. Don't let it be a surprise. Don't let them find out on the back end, oh, by the way, I'm giving away half of our estate to X, Y, or Z charity. I mean, what you've done then is you've created a lot of animosity in that regard. Teach them as they.
I want to bump in because I've been face front with that same issue. This was the World War II generation person who became my new best friend and gives a huge gift. And then I meet their children, and boy, they melt me with their eyes. How do you all recommend families have conversations about what they're doing with their money?
Set goals. First and foremost, you got to set goals. What is it that you want to accomplish with the money? I made a list. Is it self-satisfaction, self-gratification, if you will? Is it tax efficiency? A lot of wealthy donors, even not so wealthy donors, use charitable giving as a way to improve their tax efficiency. Is a kind of a LOL, if you will. Do you just want your name on a building? And any of those is fine, but you have to have the discussion and to set out what those goals are. It's no different than general financial planning. What are your goals? And then we work backwards. And
I think it's important. I'm sorry.
Go ahead, Todd.
No, I was good. I think it's important to have the meeting. That's the one thing that I don't think happens as much, especially with baby boomers or those are even older than that. Maybe they don't have the discussion of their money, of the wealth, just because maybe because they never had it with their parents when they were younger. And it was never just something that they put out there in public, or at least within, among the kids and other family members. But I think that's the first step is having the next generation understand what the wealth is. What kind of wealth is there, and then have the discussion as far as the charitable inclinations that the family might have had in the past and want to continue in the future.
And I'm going to add one more piece to that is make sure that if you want it to be a familial process of giving, that the children and or the grandchildren, if it's applicable, actually participate in the discussions with advisors and charities. That way, everybody's on the same page.
And there's strategies that allow there's planning strategies that allow that. I'm not going to spend time talking about private foundations, but private foundations, you can employ your kids, your grandchildren, to help them understand how it works and how they give the money and who they give the money to. with DAFs, usually the donor is the one who's the decision maker, but most DAFs have a successor, to that individual to make those financial decisions or gifting decisions as well. So there are strategies, strategies out there to help, bring the family together in that regard.
Again, I want to check if the audience, we'd rather have you come on camera. Come on camera if you got a question or a comment.
We had another question from Kristen earlier.
Kristen, would you like to come on camera?
I don't think she has her camera on, so I'll just go ahead and read it for her.
Please. Okay.
It says, what types of donation vehicles would you suggest a newly established planned giving program should offer?
That's a great question.
That's a good question. I mean, vehicles, it's a lot of times I think, and I'm not an expert in this area, but, I think, planned giving officers, they sort of focus on estate planning. Put me in your will, put us in your will, put us in your trust, make us a beneficiary of your IRA, make us a beneficiary of your life insurance. And I will tell you, the one thing I didn't mention when we talk about retirement accounts, if I always bring this example, if you have, $50,000 that's, not in a retirement account, and you have $50,000 that's in an IRA, and you want to give, $50,000 to your child and $50,000 to a charity, which is the better vehicle to do that from? And that's where, IRAs are a better vehicle to give to charities as compared to just, a brokerage account that you might pass away with because of the income tax. So, that's an avenue, for charities to pursue, saying, hey, you know what, if you want to, if you have IRA assets, they're a lot more efficient in a charity's hands than they are in an individual's hands, because of the tax aspects.
Mm-hmm. Mm-hmm. Good. Hey, Michael, any other questions? And I still have some more. I'm not going to let these guys off the hook.
I don't see any other questions in the chat, but if anybody wants to go ahead and ask a question now, now would be the time.
I'm going to put in one. This is another Eskinism. I call it I love low-hanging fruit because I'm a short guy. I can't tell you how many times, Todd and Fred, either I worked at a nonprofit or heard about a nonprofit that gets a huge bequest, and it's as big as a surprise. I mean, I can give you 3 instances where I'm talking over 25 million. And you know what they have guys like me and Marv do? We're researching. Fred Steubing just left us $27 million. Who is he? It turned out he took one class. This is an actual university here. But your low-hanging fruit would be asking your nonprofits, your donors, let us know if you have included us, in your estate plans. And typically, you can start a very low cost recognition society in which maybe you have a dinner or they get a private video chat with the president or something like that. That's your low. I can't tell you how many bequests come in as a complete surprise. Okay.
And Jim, you make a really good point in that as a donor, you should be having conversations with nonprofits that are important to you and causes that are important to you for two, maybe even 3 reasons. One is you got to let them know the gift's coming. I mean, it's coming at some point in time. They need to have a plan for that gift. It doesn't need to just sit there. It needs to go to work. 2, you might have something specific that you would like to see your donation go towards. Well, does that align with the mission of that nonprofit? You need to know that as well. And having, again, communication and having those discussions is key. And it can't be done too soon. Like, you can't wait until you have time. You need to be doing it now.
Hey, let me ask, this is for both of you. For our nonprofit friends like Susan, like Keith, and all the others, how can they network with the Fred Steubings and the Todd Janowers of the world and all the other financial experts?
I'll jump in on that one first, and then I'll pass the baton to Todd. I have a lot of clients that are high net worth, ultra high net worth, of average net worth, if you will, and they're always looking for opportunities to give. And truth is, they don't know where. They don't even know where to start. They're like, hey, I want to help, I want to give, I want to do these things. As a financial advisor, I'd like to know what organizations are in our community that are looking for opportunities to match with donors. You know, reach out and give us a call and say, hey, you know what, Fred, this is the organization I work for. You know, have you ever had any conversations with donors that, you know, potential donors that might align with our vision and our mission and our goals? And then if it is, obviously we're not going to disclose private information, but we can go back and then talk to those clients and say, hey, you know, we mentioned in your estate plan that you have this as a goal for giving. Have you thought about the different charities? And here's some examples. Do these align, or do we need to look for something similar or completely different?
Hey, Fred, I don't like putting you on the spot, but I am going to put you on the spot. But if
Nice.
we have some nonprofit, you're not even surprised. If we have some nonprofit friends who said, you know, we ought to be talking about DAFs. We ought to be talking about charitable quests. We ought to be talking about retirement plans and life insurance, but we don't know how to get started. Is it fair to say they can reach out to you for a in-person or a virtual discussion?
100%. I mean, you and I have talked a lot, Jim. I've been involved with nonprofits since I was about 14 years old. So I'm not going to tell you how old I am or how many years that is, but it's a while. And I believe in the nonprofit, the mission of nonprofits in our community. And I'm always looking for ways to connect donors and nonprofits. That's to me, that's a huge uplifting action, is to be able to say, you know, here's part A, here's part B, and together they make this wonderful marriage of goals and money.
I'm going to throw this one in. It's important, I believe, and maybe all Fred and Todd share, you have to lead by example. And the nonprofit in which senior management and the board leadership has committed to estate or legacy gifts themselves are going to have a lot more credibility and momentum when they approach their friends.
Absolutely. Yeah.
I would agree 100%. You know, it's not what you say, it's what you do.
And by the way, a lot of what we know, people who give, you know, it's not an either or. People who make a lot of legacy or estate gifts or plan gifts, we have different names. Research shows us they'll increase their annual gifts. It's not like they're going to say, you know, rob Peter to pay Paul. I mean, you're just going to increase and improve the relationship that you have with your donors. It's as much emphasis as there has been a huge spike in creating wills over the last year for obvious reasons. Todd, I think it's like 2/3 of the population still hasn't made a will.
Well, that sounds about right. That's actually, everyone has a will. The question is whether you're drafting the will or the state's going to draft one for you. So, I mean, your will, you have the control. You say where your money goes to, who gets it, when they get it, how they get it. With the state, when the state has their, you know, drafts their will for you, it's under the state rules and you can't change it. It might go to people, you know, distant relatives that you don't talk to anymore. So, you know, it may not be, it's probably not the most efficient way to transfer your assets. So having a will, having control over your assets and where they go to is the most beneficial way.
On purpose, I'm going to ask you all to repeat yourselves. I think one of the biggest misnomer is just thinking that a state legacy plan giving donor has to be Bill or Melinda Gates. I guess they're now making two decisions, or, you know, the most wealthiest among us. But truly, the middle class has plenty of opportunities to plan gifts from their estates. Todd?
Yeah, a lot of times, you know, a lot of gifts are maybe around religious things, and they want to leave something to their church or their synagogue or whatever. And it's easy to put something, you know, a small amount in your will, whatever that amount is, or it's easy to write at the end of the year around Christmas time to write, you know, a check or something like that, to a small check to either to a DAF or directly to a charity. And I think, you know, those small, you know, I think charities rely a lot on those smaller gifts too, and not just the larger gifts that wealthier people would make.
Okay, Todd, we got through to somebody on the other end, you know, and they're saying their executive director, their board chair, they're going to call each other tomorrow morning and said, we DAFs, I mean, they're the most dynamic and explosive part of philanthropy. what are the early steps? You don't have a program, you haven't been talking about it. How do you get started?
Well, you mean creating your own DAF?
No, this is for a nonprofit who's going to market. It wants to do a better job of soliciting DAF gifts from their donors.
Right. I mean, I think it's maybe letting. I don't think it's any different than soliciting gifts directly from the donors. I mean, it's having, if they have the donors that have given regularly, and they may or may not have had have a DAF, but I think it's letting them know that, hey, if you have a DAF, we take DAF gifts that you can give through your DAF as well as writing us a check, and sometimes helping them understand why maybe a DAF might be better, in the sense that you don't have to make that decision today. A lot of times in the past, people have, in order to get an income tax deduction. I talk from the tax perspective a lot. I apologize, but in order to get deductions, they have to give their itemizations have to be more than the standard deduction. And sometimes people don't have that from a year to year basis, but maybe they can bunch them up in every other year. So they may want to, give 2 years worth of charitable gifts to a DAF, which they can and get that deduction, but not actually make the gift in that year. They can actually spread the gift over a couple of years if they wanted to, so they could still make those annual gifts. But so that's where we're going with that. But they do have those, again, the simplicity of the advantages, letting them the donors know that they do accept gifts from DAFs.
And one of the things I want to inject my 2 cents after 30 years as a fundraiser, typically the donor isn't inspired to make a DAF gift because of the DAF or a charitable trust or a pension plan or a life insurance policy. Those are vehicles to implement. Maybe their dream is scholarships. Maybe it's building a senior center. These estate gifts are all wonderful ways that they can build their capital for doing good.
Yeah, they could get, make the gift today and not worry about making the distribution until sometime later, when the accumulates.
We're finishing up here. Michael, do we have any other questions? I'm going to take advantage of you because I got a feeling you're on Zoom and video conferencing a lot more. And all our donor and nonprofit friends are talking of the problem of computer screen fatigue. As folks who probably suffer from it as much as any, do you have any tips for nonprofits on how they can minimize computer screen fatigue?
Well, in Texas, because that's where we're at, my advice is if you can do in-person meetings are number one by far and away. Hand to hand, face to face, they work. As far as Zoom meetings, ask in advance for a Zoom meeting, and then be concise, be clear in what your meeting is about, and then be respectful of time. Don't let those kinds of things drag on.
Hey, Todd and Fred, the time just flew by. We want to explain what we're going to do. We're going to post a brief 1,300 character space summary of this discussion. That's the LinkedIn's limit in the next 5 or 10 minutes. And then Michael Largent is going to do his magic spin dry, and he's make a recording available that will also post on Facebook and LinkedIn. And again, Fred, I said I'm not going to put you on the spot, but I guess I'll do it again. Did I said that you also can follow up on our summary and put a link in then that people can actually schedule a meeting with you?
Oh, absolutely. Yeah, I can give you a link, Jim, to my calendar, and anybody who wants to schedule time with me can click on that link and they have access.
I'd like you to do, because that's before I can have my glasses Infidel. We got to do the immediate posting. And then I'd like you to just follow up on that and just, here for those of us, for those of you who want a conversation about some of these estate strategies, just let me know. We'd be glad to meet with you virtually or in person.
Mm-hmm.
Todd, one of my favorite quotes as we're ending here, and thank you, the time just flew by. And the late poet Maya Angelou said that people will never remember what you said. They won't even remember what you did. but they'll never forget how they made you feel. And our job as fundraisers is to make the donor and the donor prospect feel like the most important person in the world. I'll give you a final question. This year in history, there's only been one person who delivered a poem recited at a presidential inauguration and then did it at the Super Bowl, and that is
Amanda Gorman.
and I love the title of this poem is called "The Hill We Climb," and we think that's what we're doing in the nonprofit sector, and we're not afraid of. We've climbed hills before, and I want to thank our MassMutual representatives, Fred Steubing from here in San Antonio, and Todd Janower in Scottsdale, and for being part of the family of the Hill We Climb. And I want to thank all our attendees. If your nonprofit's big or small, whether you're in child care or senior care or animal care or health care, you are making a profound difference in making this a better world. And we want to thank you for everything you do. By the way, Todd, I leave people with a money back guarantee. How's this? And I tell them your chances of getting the gift go way up when you ask. Your chances of getting the gift go way up when you ask. That's a money back guarantee. Thank you to Fred and Todd. It was a very rich hour. And to our audience, we'll see you next week. Stay safe. And Michael will have a recording available, probably in 60 to 75 minutes.
Yep. Yes, that's about right.
Okay, and thank you. I don't know what I was doing with my earbuds, but I butted back in. Hey, Todd,